Hi, hello everyone. Let's discuss on very important topic of the infrastructure finance, which is the limited recourse lending, where we are going to how the financial agreement with the restructured borrower liability will affect on the limited recourse lending. So before we are going to move to the details in this video, guys, I would like to request you if you are new to the my channel and if you are interested in the infrastructure financing or the quant analyst role or the business analyst role or the risk management role in the bank, like operation risks, credit risks, or the liquidity risks. So please like and subscribe my channel. So I'm continuously creating videos on these topics, guys. So let's move where we are going to discuss on the understanding the limited recourse lending. So where we are going to discuss the definitions and the core characteristics of limited recourse lending. So where we discuss on the concept of limited recourse lending. So lender claim is limited to project specific revenue and the asset rather than borrowing the overall asset. So as a lender, you are the overall owner of all the assets that purchase from the your loan amount. So you just claim that amount, and you are not using the personal assets or other business assets of your the borrower. So you should be generating the course lending from that finance. And the risk allocation and due diligence, lender assess the project viability through cash flow forecast and risk allocation and the contractual agreement. So while if you are the lender like NAFAD, National Bank for financial institution and the development, so they need to understand very detail of the cash flows, risk allocation and the contractual agreement that while before funding, to understand that thing and check the debt service coverage ratio or the loan life coverage ratio, or that do the different kinds of stress testing on that project. So once you are comfortable, then give the loan, because it's an the non-recourse financing. So that's why you are not claim the assets of that the sponsor. Then hybrid recourse structure, so early stage partial recourse shift and limited recourse post construction and balance the risks and liability, so that will happen. And the security features and monitoring, so loan include the layering security like escrow account, waterfall cash distribution with ongoing monitor. And there are the milestone based payment, fixed term contract, or the floating term contract, or the boat model, or the on boat we build, operate and transfer kind of model, or the hybrid annuity model. So these kind of models, there's accordingly you need to understand that model and do the financing. Let's move on the next slide, where we are discuss on the key stakeholder and their role in the limited recourse financing. So first stakeholder is a special purpose vehicle. So the special purpose vehicle is an independent legal entity managing the project contract, asset, and revenue to serve the debt of that in the project finance. And the project sponsor and the guarantee. So sponsor provide the equity and limited guarantee during the construction to reduce the compliance risks for the lender. Then lender and the due diligence, lender conduct through the technical and financial and legal assessment to mitigate the risks before the financing. So lender will do the technical, financial and legal assessment to check all the backgrounds of that thing, who is the sponsor, what are their track record in the last 10 year, how much currently project they are working, understand all the financial, debt service coverage ratio, loan life coverage ratio, how the current asset current liability ratio, or how the availability class. So all these things do, and then do the legal assessment, contract terms and conditioner, consignment contractor, how the that will work. And then do the financing and the construction and the operation contract built under the fixed price contract, and the engineering procurement and construction contract, operation and maintenance contract. All these are the fixed price based contracts where operate ensure the ongoing asset performance and the compliance will work as we are expected. Then a risk allocation and the comparison with other resource structure. So construction risk allocation, construction risks like delay and cost overrun are allocated to projects at the earning procurement and construction contract via fixed price contract operation and market risks is there. So operational risks rest with the special purpose vehicle and operational and maintenance contract. Market risks is vary by project and type of, include the revenue fluctuations, lender risk protection, lender mitigation, credit and financial risks through the conversion dates, sizing and the coverage ratio, reverse and covenants, and then recourse structure comparison. So limited recourse lending balance and lender security and sponsor liability better than full and non-recourse lending. So let's move on the next slide, where the advantage and limitation and the project implementation for the project finance. So advantage of limited recourse lending, limited and challenges and the practical implementations of the project finance. So advantage of limited recourse lending, so risk isolation, protected corporate asset by housing project with special purpose vehicle, off balance sheet treatment, improve the leverage and borrowing capacity. Higher interest rates, transient covenant, and complex structure increase the cost and require the interdisciplinary expert for the successful financing. And the project implementation, strong special purpose vehicle govern the reliable contract and the stable regulation and continuous monitoring and essential for the project success and the financial sustainability. That things is comes under the limited recourse lending.